All right, Valero's latest earnings report just dropped, and wow, it is a story of some incredible highs and a few surprising turns. We're going to break down the big wins, a major challenge they're facing, and their game plan for what's next, all in about 5 minutes. So let's jump right in.
So right off the bat, the big headline here is a solid beat. Valero just sailed past what Wall Street was expecting. Their earnings per share came in at $3.82, absolutely crushing the $3.10 estimate. And on the revenue side, they pulled in over $30 billion. That's a full $2 billion more than anyone predicted. Just a really powerful performance on both the top and bottom lines. And all of that, translated into some serious profit. For the quarter, their adjusted net income hit a massive $1.2 billion. A number like that really sets the stage and tells you there's some real strength in how they're running the business.
Okay, so where did that impressive performance actually come from? Let's dive into our first section here and look at the engine that was really driving these numbers. Valero's main business, refining.
Yeah, the refining part of their business was an absolute powerhouse this quarter. It generated $1.7 billion in operating income. Now, to put that into perspective for you, this one single segment brought in more income than the entire company's net income. It just goes to show you how absolutely critical refining is to Valero's success.
And Valero's CEO, Lane Riggs, he pointed directly to this. He basically said that their financial success comes from how well their facilities are running. He highlighted record-breaking performance not just for this quarter, but for the entire year, and he chalked it up to their focus on safety and reliability. So they're not just making money, they are running their machinery better than they ever have before.
Now, the CEO mentioned a key term in there, throughput. So what is that? Well, simply put, it's just how much crude oil a refinery can churn through. Hitting a record throughput means you're running at absolute peak efficiency, squeezing every last drop of valuable product out of every barrel you buy. It's a fantastic measure of just how well you're operating.
But, it wasn't all good news and record-breaking stats. Moving into Section 2, the report also revealed a pretty significant challenge coming up for the company.
And here it is. Valero announced that they're shutting down refining operations at their facility in Benicia, California. This is a huge strategic shift for them, and believe me, it comes with some very real and very immediate financial pain.
So what's the actual financial damage here? Well, the company has already eaten about $100 million in extra costs this past quarter. And looking ahead, they're telling us to expect a 25-cent negative hit to their earnings per share in the very next quarter. So this isn't some far-off problem. The impact is already hitting the books.
Now let's switch gears and talk about Valero's green energy segment, because that part of the business showed a much more complicated picture. Section 3 is all about the mixed bag they got from their renewables division.
And you can see a really stark contrast here. On one side, you've got renewable diesel, where operating income fell pretty sharply, down to $92 million. But then you look right next to it, and the ethanol business had an absolutely incredible quarter, with its income surging all the way up to $117 million. It's really a tale of two completely different biofuels right now.
Okay, so refining is strong, they've got a major closure underway, and renewables are, well, they're sending mixed signals. So what's the plan going forward? Let's get into our final section and look at Valero's strategy and how they plan to keep rewarding their investors through all this.
To really understand their strategy, we've got to ask a simple question first. In this current environment, what is Valero's biggest advantage in the market?
And the answer is all about the kind of oil they can process. See, the price for lower quality, heavy, sour crude is getting a lot cheaper compared to other types. And it just so happens that Valero's super sophisticated refineries are built specifically to handle this exact kind of cheaper oil. It means they can buy their raw materials cheaper than their competitors can, which is a massive advantage. And just so we're all on the same page, sour crude is just oil that has a lot of sulfur in it. It's cheaper for a reason, it's much harder to refine. But because Valero has already spent the money and invested in the complex machinery to do just that, this market trend becomes a direct competitive edge for them. So what does this all add up to? Well, this combination of running their plants really well and having this smart crude advantage leads to one key thing for investors: a whole lot of cash. Over the course of 2025, Valero returned a staggering $4 billion to its shareholders. So how are they doing it? Well, they just announced a 6% hike in their dividend. They bought back enough of their own stock to shrink the share count by 5% last year. And they're sticking to a clear policy: give 40 to 50% of their operating cash right back to investors.
And this really brings us to the final critical question, doesn't it? This quarter perfectly captures the two sides of Valero's story. On one hand, you have billions being returned to shareholders, all driven by record performance and a really smart strategy. But on the other hand, you've got these major headwinds, like a really costly refinery shutdown. The big question for the year ahead is simple. Which one of those stories is going to win out?